Mike, welcome to the show this afternoon. Thanks for being here.
Hey, thanks. Appreciate being on.
Okay, so this inflation story, the Fed's pretty clearly admitting that they were maybe a little optimistic at the beginning of the year on how transitory. Has this been priced into the market, the degree to which it's sticking around and causing some volatility, or do we still have a long ways to go in this battle?
Oh, it's going to be with us for a while. I just think, the market's pretty manic, right? We focus on things that are right in front of us, right in front of our noses, and I think what we're talking about here with inflation is, if you think about what the headlines might be in 9 months or a year, we could be talking about lots of the different types of things that are driving inflation higher today to be actually lower. So we're sticking with our sort of cyclical inflation, not secular inflation. Although we're beginning to get a bit worried about that. Take a look at lumber last year, earlier this year, right? We had big spikes and it's rolled over pretty aggressively. Demand for housing prices was sky high. Demand is still high, but housing prices are also real high. They're beginning to cool down. We think we're going to see that roll through the economy, and it could very well even happen with oil. We expect oil producers to start drilling more. We expect more shale production. When was the last time you saw the oil patch show a lot of capital discipline? That would almost never.
And
I guess.
Yeah, right now I've heard more about energy than I ever have. Mike, I got guests coming on who are very quality stock pickers, as they label themselves, and demand quality from businesses, but they can't get enough of like mid-cap drillers all of a sudden. Is this not just the latest hunt for yield?
Right. Well, it certainly is. Again, it's that short-termism that we suffer from. Our job as capital allocators and working to invest on behalf of, lots and lots of people is trying to think about what the headlines are going to be in June of 2022, right? What's inflation going to feel like in June of 2022 or September of 2022, and how is that going to impact our portfolios, and what's the story going to be then? We just think it's not going to be as heightened. It's not going to be as bipolar, frankly. It's going to be a little more quiet on the inflation front. That's our guess. Having said that, we're clearly past peak COVID, which we think is an important variable.
Mm-hmm.
So let me back up a half a step here, right? So the first thing we're trying to do is the market is exceptionally interest rate sensitive, the stock market, that is. And as rates go, leadership in the market goes. So for example, when interest rates fall, you're going to see mega cap growth stocks, think FANG, think Microsoft, Apple, Facebook, Amazon, et cetera, are going to lead the market because of their defensive characteristics. When COVID is rolling over and we're getting a reacceleration feel to the market, we're going to think about small cap value to be in the opposite end of the style box.
Yep. It's been a wild back and forth. I love the way you guys have characterized this in this chart, where we can see the net result year to date. The shaded area on the right side is in favor of small cap value on the year. What you're looking at here is the relative performance, small cap value minus mega cap growth throughout these different sections on the year. So when it's blue and higher, that means small cap's doing better. When it's burgundy and down, mega cap growth outperforms. Now, if we do, though, get this kind of permanent rotation, how much can we handle the downside in tech? Mike, is there any type of circularity in this market where if the ownership has been in tech and it's down, is our outperformance for value just in a broader down market? Because that's what's been going on since September. You being your value company is great. You're only down 1% instead of 7%.
Well, there's a couple of things going on there. One is, one of the reasons we actually like the market here, even though it's relatively expensive, is because there's been this series of rolling corrections, right? Remember the sort of, to put a fine point on it, sort of the ARK investment innovation trade, the SPAC craze, all happened in February. We had this huge run up in these names. And then after that, we've seen those correct in some cases 30, 40, 50%. We had sort of a bubble building, and that's been popped. We've seen value stocks do really well the first 6 or 7 months of the year. That's come off quite a bit. We've seen the mega cap stocks come off a bit now, not a lot yet. That's keeping valuations high. So you're seeing this sort of rotating bear market. A month ago, the market averages were still pretty high, but the average stock had come down quite a bit. The breadth of the market was really weak. We think that's healthy because it's going to allow the market to continue to refresh itself, if you will, and find different leadership. So that chart you were just talking about is one we've been watching all year. Our frustration is we don't want to have to bet the success of our equity portfolios on a single variable like the 10-year, right? There's lots of things that go into the 10-year, and so you're getting kind of derivative away from the fundamentals of these companies. So what we're trying to do in our portfolios is think about how do you build a barbell with explicit exposure to those two different areas, mega growth and small value, and then let your stock selection and the fundamentals of the companies we own do well underneath that. So we can get rid of some of that bipolarity, some of that, hey, 6 weeks we have a small value run and 6 weeks we have a large cap growth run. We want to be a little more discreet and explicit in what we own there. I don't think most managers think that way. And it's a way for us to manage some of that expectation and frankly do well in any kind of, do a little better across the board as opposed to just riding the cycle up and down. Does that make some sense?
Absolutely. One of the ways I've described that rolling bear market that you talk about. Wish we had you on earlier this summer, Mike. This is right up our playbook on what we've been discussing. That rolling bear market that's been cleaning out the froth. It seems like to some degree trying to go into the next area of rotating is switching around chairs on a sinking ship. But your point is you're trying to find life rafts that take you in a completely different direction. How many of those companies are out there? How many of those companies haven't gotten frothed up in these different rotations? I mean, Southwest, we were talking last week, an airline, it was up to pre-COVID levels. Even the stuff that's like the so-called deepest value out there.
Right. Well, yeah, I'm not sure I'd say deep value for those things, right? There's some real business case worries there yet.
Okay.
One of the things we've seen is that the market isn't anticipating COVID. The market is trading sort of along with the COVID waves.
Yeah.
Right. And trading with, I'm talking about the actual dynamics underneath the market, like we've been discussing. So the market usually is anticipating 3, 6, 9, 12 months out for earnings and other economic variables. But with COVID, if you sort of regress it and think about how the market's acting, it's really acting in step with the COVID waves. In this last case, for the last few months, it's been the Delta wave, right? So what's interesting about that is, that allows you to take a concurrent view of the market and actually extrapolate. As I said in my notes, we're actually tilting a little bit towards the smaller and value side. We think that reopening is going to win for a while as COVID comes down. The headwinds to that are that we've got a lot of the stimulus from the PPE and all of the support that was in COVID all rolling off now. So we're going to have a significantly weaker stimulus environment. We've got the Federal Reserve who's beginning to taper probably next month, which appropriately. So you've got some headwinds to a reopening trade. And then you've got higher oil prices, right, which is taxed as a large tax on effectively everybody who uses oil, which is almost everyone.